Brexit, a major fiscal difference between the EU and Italy, and a change of wind direction over German politics. Add to this, from a global perspective, trade tariffs and a general rise in geopolitical angst. Oh, and is the Fed's hawkish attitude around rates going to steer us all into another financial crisis? Sean Corrigan joins us now from Cantelon Consulting. There are a lot of factors coming into play here at the moment, and one of your most recent papers is suggesting that this is different from 2008. Clearly there are some different elements here. What do you think is the big issues at the moment that we should really be focusing in on? Because there are a lot of side issues, I think, that perhaps maybe contribute to the main issue, but what do you see as the major problem that we've got?
Well, clearly we've got financial markets which have been driven to extremes in valuation by the action of the very central banks who are now telling us to worry about the fact that people have borrowed money when that's been their policy to make them borrow more and borrow at cheaper rates and for longer periods for 10 years. So number one, we always get there. And you have this curious split that the people who want to see the negative will say we're borrowing too much. But the instance the central bank gives some hint that it might not be making that quite as much of a giveaway as in the past. They say, oh my word, the central bank is tightening. So which do you want? You can find the negative in both of them. We clearly need to rebalance. So far, there has been somewhat of a slowdown in Europe this summer for one reason or another, whether it's Brexit, China, whether it's the whole Dieselgate and the assault on the automotive industry that's going on. America, however, still seems pretty much to be firing on all cylinders. There's a bit of weakness in autos, there's a bit of weakness in housing, but generally speaking, things look good. Balance sheets are overloaded with debt, but that debt is, because of the low interest rates, are a small fraction of the interest rate cost that they could have been. And so far, their revenues and profits look reasonably healthy. So they can, at the moment, they can bear the strain. Doesn't mean to say that will persist. They've clearly taken on more risk. But so far, the macro, the bad macro, really bad macro, is China. Everywhere else, Europe is flat-ish. America still seems to be firing. So we're not yet in the full gloom and doom situation economically.
But this time next year, if things pan out the way they're expected to in the States, we could well see something like another 4 interest rate rises. That effectively would take us up from, what, 2 to 3%. That's one whole percentage point, which effectively is 50% rise on where we are at the moment. You talk about the fact that we've got low interest rates, we've got all this debt. If you raise your interest rate by 1 percentage point, that does put a lot of strain on a lot of people who, as you've said, have been encouraged to borrow money at cheap levels.
Yeah, well, it depends how much you need to refinance at any period. Also, we know that a lot of this has been borrowed opportunistic floating rate, but you have derivative markets. Why haven't people swapped out? They've seen this is coming. It's been well signaled. There are no surprises from central banks these days. If you had a big bunch of floating rate debt at zero, you paid 1% to get out of it, you could be out of it for the next 10 years. We don't know this. We do know there's a big structural position on the futures market, which could be where that is actually been hedged. So the thing is as well is that as interest rates have risen with the Fed, financial conditions haven't really tightened. We've had a bit of pickup in spreads and a bit of fall off in loan and bond issuance over the past couple of months, but generally speaking, conditions have been very easy. It's been very easy to borrow money to do whatever you want to do with it. And actually real interest rates haven't gone anywhere. Real interest rates are still flat to negative. I mean, they need to be plus 2%, 2.5%, 3% to be balanced, as the whole structure of history will show you, going back as far as you can find Bank of England numbers into the 17th century. 2-3% real interest rates, things usually work. 0% interest rates don't cut the mustard.
But in the States, of course, you've got relatively healthy growth, you've got a good jobs market, and there are other things going on there that they can cope with higher interest rates. Here in the European Union, or rather the Eurozone, where we've got QE going down to 0, I believe now, still time to the end of December, and some suggesting that itself could cause problems to some of the peripheral countries, and indeed the likes of Italy as well, which has also got its own problems with the EU.
Well, the thing here is to try and, it could very well go wrong in Europe, but the problem is that if you look at the hard data of the European numbers, the European Central Bank, since it started its massive purchases in 2015, has bought something like 2 trillion euros of securities, roughly speaking. What's happened is that the foreigners have sold back 500 billion euros that they previously funded for the European Union. The ECB has funded effectively all government issue, which is about the same, and the other half of that, so $1 trillion, has been European companies and investors buying foreign bonds. So the European Union has pushed everybody else up. Internally, what it has effectively done is just substituted for the banking system. There's been M1 growth for the past year and a half has all been down to what the ECB's done. The banks haven't created any new money on top of it. And when you go beyond liquid money, the actual savings that people make and the lending that comes out of that, the M2, M3 stuff, is actually still declining. So the European Union has substituted for the banking system, and of course it's undermined its profits, and it's undermined the profits of the insurance and pension and all the other capital formation industries. It's not really done any good. So if it pulls out, is that we've cut the patient off life support death. That's what some people fear. But the experience in, admittedly, a situation, institutional and economic situation, which is different in the States, is that so far as the Fed's withdrawal has seen banks take over some of their proper credit formation functions. And you've also seen people move money out of their dead deposit accounts, zero interest, where they've put excess savings because there's been no pickup to tying them up, and they're putting them back into savings, time deposits, bond funds. And you could see this in Europe. So what could happen is the ECB could come out, and to the extent the banks have been capitalised well enough to cope with it, they could quietly absorb the slack, and the bond market could. So it's not cut and dried. It's more of a problem in Europe, definitely, than it was in the States, because it's more dependent. But it's not necessarily when QE ends, it will be dead.
Yeah, but of course, add to this, so far as the EU is concerned, there's Brexit, of course. Globally, as I said, the trade tariffs, there's political worries. What do you see as the order of events in terms of priority we should be looking at for market direction, for things that could break, that ultimately will end up taking us back to something like 2008? Well,
of course, the market itself is the first biggest problem. The market has...
Overstretched?
Yeah, it has been, clearly. I mean, we all know that you can go to anybody and find the charts of price to sales, price to this, price to that. Everything's at an extreme because interest rates are so low, and those interest rates are now coming back up. So we're changing the calculus of how we look at these things. So I've been discussing this with other people. It's not that we now think earnings are necessarily not going to grow next year, but we should be attaching a smaller present value to those earnings because we have a higher bond yield to go with it, even without worrying about what interest rates do to business earnings themselves. So this actually makes some sense. But of course, since the market's probably overshot on the upside in the enthusiasm and the no-risk environment, buy the dip and hold, hodl and all the rest of it that we've had these past few years, they could quite easily go down another 10, 15, 20% from here. And unless that triggers some non-linearity in the financial system, the rest of the world really could just sail on. We must also remember that higher interest rates, to a certain extent, there is an elasticity of credit, but they're a transfer. I'm a lender, you're a borrower. When rates are low, you're getting a good deal and I'm not. So you're spending money and I'm not. So if we go back the other way, as long as it's a smooth enough adjustment so I don't put you out of business, I now have more money to spend. In fact, I might end up spending it on your business, but you're just not going to get through my interest rates and my savings. So this isn't, again, not absolutely the one-way street that everybody tries to look at it. I am not denying that it's a vulnerability. It's where all crises have broken out and where this one probably will if we have one. But I think you have to be slightly more, you have to think two extra moves ahead on your chessboard before you completely panic about it.
Yeah, anything else that's worrying you particularly? I mean, is the trade tariffs, is that going to go on and on to form a real problem, or do you think ultimately they'll come to some sort of agreement, like let's hope they do on Brexit?
Well, with the European Union, maybe they'll get some leverage, but it looks as though he's trying to push for things which aren't really trade-related. Trade seems to be the lever with the Trump administration, not the goal. OK, it plays well to the industrial heartland, although, of course, it also costs his farming base political support. So that itself is even a moot point. We know that trade barriers, any sorts of barriers to exchange within or without a country, are generally destructive of wealth. The one possible saving grace is that Trump has made some noise about this being, let's get you to the table, and we're actually going to look at the things which aren't to do with trade, which complicate our issues. If he does do that, great. But I'm not sure China in particular is in the political position where Xi Jinping can be seen to be making concession after concession after concession to an American administration which really looks like it's going to push it to the wire when it negotiates. So that's an issue. And China's economy is very fragile at this point, probably the worst it's been in at least 10 years and possibly 20. You know, they have great difficulties. They've ridden this credit wave so many times, and every time they've tried to pull back on it, things have gone wrong and they've restarted. Well, we know that they threw everything at it last week, just about. Central bank, fiscal, local government, you name it, everybody came to the rescue, and the stock market's still lurching lower. So they're in trouble.
OK, let's get back to the point you say it's different this time around. Do you think that we do have the protections in place, whether it be the regulation, whether it be the backstops, whether it be whatever it is that's been put in place in the last 6, 7, 8, 9, 10 years that we've known from the crisis? Do you think that we are able better to address something that might happen if it is a repeat of 2000?
Well, we've built our Maginot Line, so we're probably not going to lose the war the way we did the last one, but have the generals prepared for the new blitzkrieg. There will be a vulnerability somewhere. I mean, everybody focuses on corporate debt. Yes, private equity has had huge amounts of money and borrowed huge chunks from the future and capitalised, taking it out, left businesses weaker. Look at the UK high street. Nearly every one of these big chains gone is overladen with debt. Usually there's some sort of private equity investor involved in it. What we don't have, though, or don't seem to have, obviously to find, is that third, fourth, fifth power of risk cascade that we had when we had all the CDOs, when this mortgage did this and we multiplied it up by that one and that one and that one and that. We don't seem to have that. So it doesn't mean to say there won't be a crisis. It doesn't mean to say that banks and insurers won't hurt and companies won't go bust. But I don't think it's going to be that complete boomf, the world stops, like we saw in 2008.
OK, fingers crossed. Sean.
Fingers crossed.
Thanks so much indeed. Sean Corrigan is from Cantillon Consulting, talking about the big picture.